What if I told you that betting everything on NVIDIA to double your portfolio right now might not be the smartest move, despite it being one of the most dominant players in artificial intelligence? I understand that sounds counterintuitive, but stay with me through this analysis, because I'm going to show you 6 alternative opportunities in the AI infrastructure space that could potentially offer better growth trajectories than NVIDIA at its current valuation. And believe me, the final 2 companies on this list represent a critical duopoly that most retail investors completely ignore. But before we explore these compelling investment ideas, take a moment to hit that subscribe button and turn on notifications so you stay updated with our comprehensive market analysis. It genuinely takes just a couple of seconds, and your support enables us to continue delivering this type of in-depth research. All right, let's jump straight into it. Here's what people need to understand about NVIDIA's current situation. Without question, it's a phenomenal enterprise. Without question, they're the undisputed leader in AI semiconductor manufacturing. But let me give you the uncomfortable reality. NVIDIA currently commands a market capitalization of $4.6 trillion. To help you grasp the magnitude of that number, consider this. For NVIDIA's stock to double from its present level, the company would need to add another $4.6 trillion in market value. That's essentially equivalent to conjuring up another complete Apple or Microsoft out of nothing with billions to spare. It's a staggering figure that challenges fundamental economic principles when you examine it closely. This phenomenon is what investment professionals refer to as the law of large numbers at work. The mathematics are straightforward here. A $10 million company reaching $20 million? Difficult but absolutely achievable. A $4.6 trillion company climbing to $9 trillion? That's an entirely different challenge altogether. Even when NVIDIA unveils revolutionary products like their newest Rubin architecture, the market reaction is surprisingly muted because so much anticipated growth has already been priced into the current valuation. The organization has simply reached such massive proportions that those dramatic percentage increases we witnessed in earlier years become mathematically improbable. But this is precisely where the strategy becomes fascinating, and this is exactly why you need to keep listening. There's an investment philosophy called riding the ecosystem wave, and it's remarkably powerful. Think about the actual product for a moment. When you purchase an NVIDIA Rubin chip, you're acquiring a semiconductor component. That's it, just the processor itself. Now consider what that processor requires to actually operate within a modern data center environment. It demands specialized power delivery systems, it demands next-generation networking architecture, it demands industrial-grade cooling infrastructure, it demands precision packaging technology. Every single time NVIDIA completes a chip transaction, all of these complementary technologies must be purchased in conjunction. And here's the critical insight. The companies producing these essential components are significantly smaller entities. They possess substantially more room for valuation expansion. And they're positioned to capture the identical growth wave that NVIDIA is experiencing. So let me walk through these 6 investment opportunities systematically, and I'm confident that by the conclusion of this presentation, your perspective on capitalizing from the AI infrastructure build-out will be fundamentally transformed. And please don't skip forward to discover those last 2 stocks prematurely, because I'm constructing this investment thesis methodically, and each piece interconnects with the others. Also, if you're extracting value from this analysis, leave a comment down below telling me which company captures your attention most. Engagement signals help the algorithm, and that enables us to reach additional investors who might benefit from this research. Let's begin with investment opportunity number 1. This company operates under the name Flex Limited. Some of you might recognize them from their previous identity, Flextronics. Here's what makes Flex an indispensable component of AI infrastructure deployment. They engineer and manufacture what the industry calls power shelves, and these bear no resemblance to conventional power supplies. When you're processing AI computational workloads on NVIDIA silicon, the electrical power quality must be flawless. We're discussing ultra-pure, meticulously regulated electricity delivery. You absolutely cannot extract power directly from the municipal electrical grid and feed it straight into these processors. The voltage variations, the electrical inconsistencies, the electromagnetic interference present in standard utility power would either destroy these delicate processors outright or at minimum dramatically compromise their computational performance. This is the precise problem Flex solves. They manufacture specialized power conditioning and distribution systems that integrate into every AI server rack configuration. Every single NVIDIA processor deployment requires flex power infrastructure to function reliably. There's no alternative solution. It's not an optional component. So consider the implications here. NVIDIA completes a chip sale, and instantaneously, there's corresponding demand for Flex power equipment. It's a direct causal relationship. Now, when you examine Flex's price chart, you'll observe it's already experienced significant appreciation. It's currently trading in the vicinity of $67, which positions it near its 52-week high. Some analysts might interpret that and conclude the opportunity has already materialized. But here's what the data actually shows. Flex, similar to most semiconductor supply chain stocks, experienced severe price compression during the recent chip industry correction. They're only now recovering to valuation levels they've historically achieved, which indicates there's still considerable upside potential remaining, particularly with significant catalysts approaching. The compelling aspect of Flex's business architecture is the competitive moat it establishes. Once a data center operator installs Flex power infrastructure for their NVIDIA deployment, they're effectively locked into the ecosystem. Every capacity expansion, every technology upgrade, every additional rack they commission requires incremental Flex hardware. The competitive barrier strengthens with each successive installation. So when NVIDIA reports accelerating earnings and provides optimistic forward guidance, you can reasonably infer that Flex's projections will follow an extremely similar pattern. They're fundamentally linked together in the most advantageous way possible. Moving forward to investment opportunity number 2, and this company is particularly intriguing. The organization is called Coherent, trading under ticker symbol COHR. Coherent operates within the photonics technology sector, and if photonics is unfamiliar territory for you, let me explain why this technology represents an absolutely critical infrastructure component. Previously, when you connected computing systems together, you utilized Ethernet cabling, those Category 5 cables that likely still connect devices in your home. But contemporary data centers no longer operate using that architecture, especially not for AI applications. Everything has transitioned to fiber optic communication. Everything relies on photonic technology. We're talking about interconnecting server rack arrays with each other, linking individual processors within identical systems, all of it operating on fiber optic cables, transmitting information via lightwave pulses. Why does this technological shift matter so profoundly? Velocity translates directly to profitability in the AI computing world. The faster information can transfer between processing units, the faster those processors can execute AI computational tasks. If you've recently committed millions of dollars toward NVIDIA's latest Rubin architecture, which can process calculations at extraordinary speeds, it makes absolutely zero economic sense to create a performance bottleneck with inadequate networking capacity. It's analogous to purchasing a Porsche capable of theoretically reaching 200 miles per hour and then exclusively operating it in a shopping center parking lot. What would be the purpose? So every organization upgrading to NVIDIA's new processor generation is simultaneously upgrading their networking infrastructure to Coherent's photonic solutions. They have no choice, otherwise they're negating their capital investment. But Coherent possesses an even more substantial competitive advantage that remains largely unknown. The highest performance method for transmitting data using photonics involves something called an indium phosphide laser module. And Coherent essentially monopolizes the entire indium phosphide materials supply chain. They've achieved near-complete control over this critical raw material. So whether you're constructing your own photonic systems and require the raw indium phosphide substrate, or whether you're purchasing fully integrated laser assemblies, you're transacting through Coherent. There's genuinely no way to circumvent them. This creates extraordinary pricing authority and guarantees they extract value from the comprehensive AI infrastructure expansion. Now, Coherent has already delivered exceptional returns. The stock has appreciated roughly 78% over just the past 3 months. It's trading in proximity to all-time highs. Some market participants might observe that and believe the opportunity has concluded, but examine this data point. Company management is projecting approximately 17% sequential quarter-over-quarter revenue growth. That's not annualized growth. That's quarterly consecutive growth. If they sustain that trajectory, and if NVIDIA's Rubin processors achieve anticipated sales volumes, Coherent's revenue is going to expand exponentially. Once the stock price breaches that $200 psychological resistance level, I anticipate we could witness momentum really intensify. Certainly, Coherent already represents a $31 billion market capitalization, so doubling might require a couple of years rather than several months. But compare that timeline against NVIDIA. Which company do you believe doubles faster? A $31 billion enterprise with 17% quarterly growth or a $4.6 trillion corporation? All right, let's discuss investment opportunity number 3. This is Amkor Technology, ticker symbol AMKR. Here's the industry dynamics with Amkor. NVIDIA designs and fabricates the semiconductor chips, correct? But someone still must take that finished chip and integrate it onto a substrate. Someone must stack the memory arrays. Someone must execute what's called advanced packaging processes. This represents highly specialized manufacturing capability. There are only a limited number of companies globally that can perform this at the scale and precision standards required for cutting-edge AI processors. The primary competitors are TSMC, Intel, and Amkor. Now, TSMC is presently overwhelmed with customer demand. They're operating at maximum capacity. Intel continues struggling to get their advanced packaging operations fully productive. They're making progress, but they haven't reached full capability yet. This positions Amkor as the capacity relief valve for the entire semiconductor industry right now. And here's the strategic element. Amkor is the only significant advanced packaging company headquartered in the United States. They're manufacturing out of Arizona, which, if you've been monitoring industry trends, is where virtually every chip manufacturer is constructing new production facilities currently. There's a substantial governmental push to repatriate semiconductor manufacturing to American territory for national security considerations, and Amkor is optimally positioned to capitalize on this reshoring trend. If you analyze Amkor's stock performance, you'll notice it's approaching its 52-week high, but it's also encountered some recent price volatility. There's been some institutional capital rotating away from the semiconductor sector. But here's what's noteworthy. Retail investor capital is absorbing every share the institutions are distributing. As rapidly as institutional money exits, individual investors are establishing positions. This signals to me that informed retail traders recognize the opportunity present. They understand that the semiconductor downturn is concluding, and Amkor is positioned to be a primary beneficiary of the subsequent growth cycle. Investment opportunity number 4 is Navitas Semiconductor, ticker NVTS. This company is advancing gallium nitride technology, and this is where the science becomes genuinely fascinating from a materials physics perspective. Gallium nitride is intrinsically superior to silicon for power management applications. It processes electrons roughly 1,000 times more efficiently, and it dissipates thermal energy dramatically more effectively. Every high-speed charging technology utilizes gallium nitride. Any application where processors generate extreme heat extremely rapidly, gallium nitride outperforms silicon based on fundamental physics. There's no technical debate about it. Now, consider AI computational workloads. The 3 critical limiting factors for AI are processing velocity, electrical efficiency, and thermal management. Those are the 3 variables that determine how much AI computing capacity you can deploy in a given physical space. Silicon-based chips are approaching their fundamental physical limitations across all 3 of those dimensions. When you maximize what silicon technology can deliver, you must transition to the next generation material. And that next generation material is gallium nitride. Navitas is the industry leader in this technology space. They've got the engineering expertise, they've got the manufacturing infrastructure, they've got the intellectual property portfolio. Navitas has experienced an absolutely volatile trading pattern this year. At one point, the the stock had increased more than tenfold from its lows, reaching $17 before consolidating. That kind of price volatility might concern some investors, but I interpret it differently. It demonstrates that the market recognizes the potential opportunity here. The question becomes, where does the fundamental value stabilize? I believe the answer involves understanding that as AI processing requirements intensify, thermal management becomes non-negotiable. Navitas's capability to engineer gallium nitride and manufacture superior power management systems provides them a sustainable competitive advantage. This isn't optional technology, it's going to become mandatory technology as we expand the performance boundaries of AI systems. Now, before I disclose the final two companies, I need you to take action. If you haven't already subscribed to this channel, do it immediately, click that button, activate the notification bell, and here's the rationale. The market is evolving incredibly rapidly right now. The AI infrastructure construction is happening in real time. Missing even a single one of our analyses could mean overlooking an opportunity that could materially impact your investment portfolio. Also, share this presentation with anyone you know who's interested in technology investing. The more investors we can inform about these opportunities, the better outcomes we can collectively achieve. And leave a comment informing me which of these companies you find most compelling. I review every single comment, and your input helps me develop better content for this audience. All right, opportunities 5 and 6. These are the unexpected selections, and they're absolute market dominators. These two companies constitute what economists call a duopoly. They're the only two enterprises that provide what they provide, and what they provide is absolutely foundational to the entire semiconductor industry. These companies develop the design automation software that every chip manufacturer uses to architect their processors. Before NVIDIA can transmit their chip architectures to fabrication facilities to be etched onto silicon or gallium substrates, they must utilize software to generate those designs, and there are only two companies that produce that software at the sophistication level required for cutting-edge AI processors. Both of these companies are currently collaborating directly with NVIDIA. One of them recently received a $2 billion strategic investment from NVIDIA. Let that information register for a moment. NVIDIA, a company valued at $4.6 trillion, determined it was strategically important enough to invest $2 billion into this company. The other company has approximately 20% upside, according to Wall Street analyst consensus price targets. But here's what's genuinely interesting. For both of these stocks, analysts continuously chase the price targets higher. The stocks consistently trade above analyst projections, and then the analysts revise their targets upward. This generates a type of positive reinforcement cycle, where the market is consistently confirming that these companies understand their strategy and are executing better than anticipated. Investment opportunity number 5 is Synopsys, ticker symbol SNPS. Investment opportunity number 6 is Cadence Design Systems, ticker CDNS. These two companies control the chip design software marketplace. If you're architecting advanced semiconductors, you're utilizing Synopsys or Cadence. There's genuinely no viable alternative. This provides them remarkable pricing authority and ensures they capture economic value from every new processor generation. As chips become more complex, the software required to design them becomes more valuable. As AI processors push the boundaries of what's technologically feasible, Synopsys and Cadence become even more indispensable. Think about the strategic position these companies occupy. NVIDIA requires them. AMD requires them. Intel requires them. Every chip manufacturer requires them. And as the AI expansion drives demand for more sophisticated processors, it simultaneously drives demand for more advanced design automation software. These companies are picks and shovels investments on the entire semiconductor industry, but with a crucial distinction. They're not commodity picks and shovels. They're highly specialized, extremely difficult to replicate tools that only two companies can deliver. That's approximately as close to a predictable winner as you can identify in equity markets. The elegance of this approach to investing in the AI expansion is that you're not speculating on a single chip manufacturer. You're not hoping that NVIDIA sustains its market leadership or that some emerging competitor doesn't arrive and disrupt the competitive landscape. You're investing in the infrastructure that enables the entire ecosystem. Regardless of who prevails in the AI processor wars, Flex still must deliver power systems, Coherent still must deliver photonics, Amkor still must package the processors, Navitas still must deliver gallium nitride power management, and Synopsys and Cadence still must deliver the design automation software. These companies succeed regardless of which chip manufacturer emerges dominant. So let me synthesize this entire analysis for you. NVIDIA is an extraordinary company, and they're going to continue expanding. But the law of large numbers indicates that explosive percentage gains are improbable from current levels. A $4.6 trillion company simply cannot double as readily as a smaller company can. But the companies that enable NVIDIA's ecosystem, they're substantially smaller, they have significantly more room for expansion, and they're directly connected to NVIDIA's success without being constrained by the same valuation limitations. If you're seeking to potentially double your capital over the next year or two, these 6 stocks warrant serious evaluation. Flex for power infrastructure, Coherent for photonics, Amkor for advanced packaging, Navitas for gallium nitride technology, and the duopoly of Synopsys and Cadence for chip design automation software. Each one performs a critical function in enabling AI infrastructure to operate, and each one stands to benefit enormously from the continued expansion of AI data centers. Now, I want to hear from you. Which of these 6 stocks are you most interested in? Are you considering adding any of them to your investment portfolio? Have you conducted your own research on these companies? Share your thoughts in the comments below. Let's initiate a discussion. And if you found this analysis valuable, hit that like button, share it with your investing community, and make certain you're subscribed so you don't miss our next comprehensive dive into market opportunities. The AI revolution is just accelerating, and the companies enabling this revolution might represent the best investment opportunities of this decade. I'll see you in the next video.